Hey guys, today I'm going to be talking about how to get higher RR in your trades. And I'll be covering like how to trade the retracements, which is just to get better entries, how to trade, how to identify proper liquidity sweep, how to manage your trade, where to set your stop and take profit. But I'm going to be explaining how to understand what's actually happening with liquidity during a proper liquidity sweep and why price retraces so you can understand and you won't be scared or feel like you're gambling on the retracement. I'm using this example from last week again because order flow has been horrible this week. It's FOMC week. I don't even know where market is right now. I'll go check. Um, yeah, I don't want to trade this. It's random. Like this is the type of price action in this week that like you'll find your setups in hindsight, but when you're sitting in the market, it's just horrible. And a lot of these big moves are happening at random times. Like today, price ran at 5:50 a.m. Anyways, in this example, we see that there's a previous day high that price eventually traded to, but we're going to pretend that we're not here yet. And we have price going lower, creating a buy side liquidity up here, taking out sell side, eventually creating a low here in Asia, meaning that all the sell side has always been taken and it's all stacked under this low as a high resistance low, meaning that this specific low is likely to be swept. When you have low resistance liquidity, price is likely to run through it, but no individual low has the capacity to actually sweep unless, and I'll explain later, all the buy limits from the institutions were under here, but there's no reason to because they know they can accumulate more sell stops to fill in more of their orders over here. Let me define liquidity real quick. Liquidity is the ease to enter orders without the market moving. What does that mean? Not market moving as in, look, market moves after a liquidity sweep, as in slippage. More liquidity means more orders in the market, meaning for whenever you buy, there's a seller or a sell limit, passive liquidity, and I'll explain that in a second too, right next to where your order is. Meaning that instead of buying at 100 and it actually enters you at 101, you'll buy at 100 and it'll enter you at 100.25, or in even better cases at 100 and what's it called? At 100, at just 100. Now, don't confuse this with volatility. Volatility could mean that price is fluctuating and there's a lot of volume. However, the liquidity is one-sided constantly. And so you're making these big moves up and down because your orders aren't being filled yet without the market moving. And why does this happen? You have to understand this for everything. Honestly, this video is more of an understanding liquidity video. Li- Price, for every buyer, there's a seller. There's no such thing as there being more buyers or more sellers in the market. There's always an equal amount. It's a trade. That's how a trade works. You can have more people buying than selling. Otherwise, you don't have people selling something for you to buy. And you that in that case, you won't be able to place an order. What you have is a difference between passive and active liquidity. Active liquidity is orders, like market orders, and passive liquidity is stop orders, limit orders, and all of the such. Your stop losses, your limit orders when you're waiting to order, and all that. A liquidity maker are people, they or institutions, they profit off spread. They place orders on both ends, they have no bias, and they fill in these orders as much as they can. There, when you market order, usually your order is being filled by a liquidity maker. They have, let's say you have this level, they have sell stops here, 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 here at every tick, and buy stops at every tick. Why? So when you sell, market goes down and someone else buys. Your sell order got placed in. You're in a position of selling, but an equivalent person had to buy for you to sell. You had a trade, right? And so what happens is why I'll explain this will all make sense in a second. Under every stop, there are stop loss, like stop limits. Market makers, they have it everywhere. It replenishes, but it gets eaten up, which is why market keeps hunting and keeps going up and down. And it'll also explain why it retraces. Under every low and high, there are stops because the ones in there got taken usually. There's just more liquidity, more passive liquidity. When you place a buy order at 100, why do you get filled at 100.25? Because you had to find a trader and the nearest passive liquidity, your limit order, until it became active, was at one tick above, and that's why market moves up and down. When you have a point of liquidity, you're just saying there's a lot of stops. Now, when price reaches here, all these passive liquidity, all these limit orders turn into market orders, and they seek the buy limits that are all under every tick here. They are literally buy limits like this. Um, what is the shortcut for? I don't remember, but like they're literally the buy limits like this. There's just a certain amount of them. They're finite. Now, what are you looking for? In main liquidity sweeps, institutions place their buy limits, so not the liquidity provided to you by market makers per se. They place buy limits here, 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 here. And why? So they can have a large number of orders placed with no slippage. Think of it. If they wanted to buy a lot here, likely price will rally up before all their orders get filled because price is looking for sell side liquidity to fill in their orders. But if they place it all here, they're likely going to be filled within this wick, which is why you get these rejection candles, and they're all getting filled at a relatively equal price because they have a lot of liquidity, meaning the ease to place orders without the market moving, to place all their orders. Now, when their buy orders get placed, what happens? How do you know that institutions bought? Well, what did I say? Now you're looking for liquidity on the sell side. And price rallies up, but it displaces up because this displacement is the initial move from the market, um, reacting to all these orders being at once. All of a sudden now you have a lot of active buy orders that all got triggered here from the active sell orders to go up. Active liquidity is what moves the markets. Passive liquidity creates the markets. So when price moves up like this, it means that a lot of buy orders were entered in the trade. And so what happens here? Why does price retrace? Well, usually it's one big move of buying, right? They're not going to continue buying because now price has got more expensive. They bought, and then there's an absence of buying. So the little amount of selling activities moving price back down. It's not going down to this low again because right here there is sell side, but it's protected because there's a lot. Price is going to be seeking a lot more buy side. However, it retraces first because there's a void of liquidity. All the nearest liquidity to fill in a sell is way down here. It's getting replenished. And so price will naturally retrace back down before it rallies up. Now what happens here? A re-entry. The institutions have entered again at a very optimal price to fill in more orders because price is re-seeking liquidity for it. And now price rallies. So retracements happen, one, because of the void of liquidity, and two, it's the sudden absence of the of the active buy orders that makes price retrace. It's not that these buy orders aren't filled, and it's not that the next bit of liquidity that they're seeking is buy side. It is. It just retraces naturally, not always, but naturally a lot of the time because of that. So when you're entering off a retracement, you should be sure that price should retrace more often than not, unless there's like some crazy volatility, and that it will retrace but not stop you out if it's a valid liquidity sweep. How do you know if it's a valid liquidity sweep? If price displays downwards, meaning it took out all these stops and there were stops, like a sudden amount of active selling liquidity got placed in the market, and we displace back up. Now, what happens when you have a displacement and then another displacement? You get fair value gaps. That's exactly what a fair value gap is. It's literally showing you that there's an imbalance, a buy side imbalance, sell side inefficiency, or sell side imbalance, buy side inefficiency, where there was a lot of active liquidity on one end, and it seeked out a lot of active liquidity on the other end, passive, and there was an imbalance between the amount of active liquidity and the passive liquidity provided. And so now when all those orders got placed in and now the opposite order gets placed in, price often goes back to it because the opposite passive liquidity is sitting there. If that makes sense, I know it's a bit complicated. You have to do your own research on this. You have to be trading for a while, be in the markets to realize this. But what happened here? We had a change in the state of delivery. We had active sell side delivery, buy side delivery, the retracement naturally to seek out liquidity needed to complete one, all the buy orders, and two, institutions will re-enter if there's more displacement, and three, the liquidity void created by this displacement on its own will draw price down. And now what happens? Price rallies. Now, this is the difference. You want to be setting your stop loss under the at the low or a tick under even because that low is protected and there is now the buying in the market is seeking buy side liquidity. It is not seeking sell side anymore. And you would target, let's say you target the previous day high, or first you target this internal high because you don't know what will be enough, which is why you have to manage your trade. Target here, 1.4 RR. If you trade like this and you're consistent, you have a win rate over 50%, you'll be profitable. But look here, there's a fair value gap here. And a fair value gap through another fair value gap or a displacement through another displacement is called the balanced price range. And where both sides had inefficiency and imbalances, and it's a very strong draw on liquidity. Perfect. You can go on a lower time frame, find the order block and all that. The charts spin when I do that, but there's probably an order block. Now, what is the order block? An order block is the move before the displacement upwards in which all the orders were filled. And price often goes back there either to fill more orders that weren't filled or allow for more orders to be filled from the institutions. They wait for the retracement, they re-enter. And then you get this big move. There's way more orders being placed before here. What does this mean? This big move. This means that there's so many active buy orders and so little um, sell side liquidity that they all entered. Now, price has filled those orders and they're now active buys in the market, their positions, and they're seeking the opposite trader to fulfill them. Or they're seeking buy side liquidity. And not like fulfill them as in enter them, but like market is pushed higher now as it like more buyers enter the market because sell side liquidity is taken out. And so you will have enough liquidity provided to enter, but institutions can't enter. You have to understand the difference we're talking about is the amount that's being traded in, which is why you can enter at any moment, but they can't. Because if they enter here, their orders will be placed throughout this range. If they order here, their orders will be entered up here. That doesn't help them. The move has already happened. They'll be filled throughout here as price is always hitting liquidity as it's going up. There's just a large amount of gathered liquidity, like a liquidity pool above these highs, way more than there is throughout every level in the market. And so I hope that made a bit of sense. Now I'll go over this again. You have a liquidity sweep. How do you know it's a proper liquidity sweep? Because one, like this low is a session low and it's high resistance as it took out all the liquidity here and it started building up liquidity up here. Price ran down low resistance. You had displacement into it. You had a rejection from it. You had displacement back up. Where do you enter? You can find the discount from the leg that created the fair value gap. On this case, it'll be up here, but those probably on a lower time frame, a different high. You can find optimal trade entry from the moment of retracement. What is optimal trade entry? Is literally just usually the amount that price will have to retrace to fill in the liquidity void. And you stack these up, and then there's a fair value gap, and you enter. What happens if you enter the consequent encroachment of this inverse fair value gap or change the state of delivery? Suddenly you go up to a 2.35 R trade. If you entered at the breaker at the BPR, you will get a 2.7 R trade. And a 2.7 R trade is nearly double what we had before. Remember, we had a 1.4, 2.8 would be double. If you enter at the middle of this BPR, you would have double. And so what will happen is you'll see price trading into you to fill you and then keep going. But you have to trust your setup and trust the fact that the buyers are in the active buyers are in the market now. And they're looking for the passive sellers, which are sitting above here and up here. And so when you see that price runs through these highs, I would put a limit here to exit, right? I'll put a limit here to take profit. The price runs here, and then once it reaches here, look what it's looking for. Internal liquidity. It's retracing on this big imbalance. Leaves liquidity here, we go up, take out this imbalance, go down, and we displace up. Now here in this displacement, we don't even have a retracement, which is just like we are in the same pool of like liquidity, in the same price in which institutions gather enough liquidity. And we hit a high here, and we just displace instantly down. There's a lot of manipulation, 930, and yeah, but so this is what I mean. You trade retracements. I explained to you how they worked, how liquidity allows for retracements to happen. I'm sorry if I wasn't the most clear. I am trying my best. It's pretty hard to explain this. It will always sound confusing at first, and then when you learn how to explain it, it's pretty hard to explain it without it being confusing because it doesn't follow your intuition. Like it's hard to imagine it it's kind of like learning electricity or like learning things about the universe. Like it's hard to conceptualize. But once you do, it would really help you to simply trust your setup and understand how the market's moving and where the market's moving to under more normal conditions, not the market before FOMC, where like it's just gambling. And so I was gonna say this is how you get higher R trades. You trade the retracement into zones of displacement and whatever you find in there, or equilibrium also. And how to manage the trade? What I would do is, as you know, the price likes to retrace. Instead of entering, let's say you enter here, put a low here, and you're overall targeting the previous day high was somewhere around here. Let's see, work it out. You're targeting here. Although, as we said, price is active looking for passive like liquidity to be filled, and price could reverse here. So what would I do? You could target this internal high created here after the retracement. I usually don't. Depends. It depends how much of the retracement there was, but I would target these highs first, and here go break even. Why? Because yeah, price can technically reverse on every internal low, but you have to trust your setups. You go break even every moment, and sometimes you just completely lose because you got the liquidity sweep wrong, and you're going for these small wins. You can be profitable like that. And if you watch Dodgy's, I learned from him. I love his videos. I love his content, and I appreciate his strategy. And it's great. And honestly, I just think I'm not good enough to trade it currently. But I like trading like this because if I'm entering off the sweep and I'm understanding the price is looking for this liquidity, I price could retrace before that. And some people could have gone break even after like this higher on the lower time frame, there would be a high, just to lose the retracement and miss out this move. And I'm waiting for that retracement. And then price hits here, and then I would scale and then go here and then exit there. And that's how I manage my trade. I said my first stop take profit at the main like a source of liquidity where I believe price could reverse naturally, and then move break even then. And then if I had another take profit up here, I just move my stop loss up to around this area. And I also try this way. I get like these 3 point something RR trades. I'm very patient until I find a good setup. A lot of this is finding a good setup. You'll find a lot of things that just don't work. Times you'll miss a setup. Times the liquidity sweeps and doesn't retrace. You can't predict the exact activity that's happening in the market, but you can search for what you're looking for and enter off that and have these really high probability trades would that have a really good win. And as long as you take them and you enter with proper risk, then you will make money. So that's a lesson. Hopefully I explained something about liquidity. Hopefully you understand a bit more about like actually taking your setups and how to risk more and how to manage your trade. and how to identify proper liquidity sweep. And yeah,